everybody out there in webinar land. Brian Cooke here, Cooke Financial Group. Welcome to our In the Bullpen session. We got a great topic today. So glad to have you. Thanks so much. We are recording today's session. There's been a couple of our clients and friends that have asked to hear more about this topic and couldn't join us today. So know that this is being recorded. If you do have a question, you can type in your question into the chat room I think it's probably at the bottom of the Zoom presentation today. But those are kind of the housekeeping issues. But really glad to have you. We've got a great speaker today from one of our trusted partners called First Trust out of Chicago. Alex Tarnow is a vice president there. He's in charge of the managed. He's a managed account specialist, and he's going to walk us through a topic today called direct indexing. It's becoming more in vogue, and we think it's a great product for a lot of clients. It's very tax efficient, and we're going to go through some of the nuances there. It fits real well with some passive investments and really well with some active investments. It's kind of a neat little product. It wasn't around 4 or 5 years ago, maybe for the retail client, but with technology, it's a great product that we're using for a number of clients today. So I look forward to Alex's comments. And again, if you have questions, throw it in the chat room and we'll start there. So Alex, welcome. Thanks for being with us today.
Yeah, thanks so much for having me on, Brian. Great to connect with you as always.
Well, and Alex is an expert. We had a couple prep calls for this, and he's very knowledgeable about direct indexing. Alex, why don't you start with, and I know you've got a few slides to show us, go at a high level, what is direct indexing?
Yeah, absolutely. I'll pull up my screen here, and we'll go from there. Brian, you know the drill. I've got a 2-year-old and a 4-year-old at home. If I'm good at anything, it's at being interrupted. So feel free to interject with any comments of your own. But what is direct indexing? I always like to start with the chassis itself, and that is that it is an SMA. SMA stands for separately managed account. So direct indexing is not a packaged product like an ETF or a mutual fund or maybe some other type of alternative structure. All we're doing is buying individual stocks in an account on behalf of your clients. So it'll say, hey, this is the Smith account. Underneath the Smith account is a number of securities. And we like to own those individual stocks for points we'll get into in just a little bit. But it's a separate account. And then it's powered by technology. As you mentioned when you introduced us here, there is a heavy technology overlay with direct indexing that powers the whole process. The cost of those technologies have come down substantially, and the benefit is really there for the end investor in terms of hopefully tax savings. So I always tell folks that direct indexing has 2 mandates. Mandate number 1 is that direct indexing is index tracking, right? We are looking to deliver an index-like return for the clients, for the accounts that they manage. And what I mean by that is maybe you want S&P 500 exposure. You can get that in a number of different ways. You could get that in a mutual fund, you could get that in an ETF, or you could get that in a direct index. But instead of owning that single ticker, we're going to buy a subset of all of the individual constituents underneath the hood of the index you want to track. So that could be the S&P 500, that could be a global index, that could be an all-cap US index. It really depends on what's the best fit for your financial goals and picture from an asset allocation standpoint. So mandate number 1 is direct indexing is going to deliver you an index-like return, right? That's the first mandate. Mandate number 2 is that we are going to continuously tax loss harvest underneath the hood of the account. And so I say mandate 1, index tracking, mandate 2, loss extracting. And what that means is underneath the hood, you're going to own hundreds of individual securities. We're investing for the long term, and we hope and anticipate that stocks go up over time, right? That's what history has told us. There's obviously no guarantees of that, but we're investing for appreciation over time. However, underneath the hood, some of those stocks are going to be down, right? And so our technology allows us to, at massive scale, go through and say, what's down? Let's sell that security to book a short-term or long-term capital loss. That is a tax asset for you. and replace it with a like-kind security to make sure you still have whole index exposure. So again, index tracking, loss extracting, direct indexing is really powerful for transitioning capital if you've got concentrated positions or allocations to investments that need to be closer to a benchmark. It's wonderful there. And last but not least, direct indexing is customizable, meaning that because you own individual stocks underneath the hood, you can customize for things like values. So say you have strong religious beliefs and you want to screen out securities that may violate those beliefs. You have the opportunity to do that with a direct index SMA. Maybe you have ESG initiatives that you want to lean into or screen out violators that maybe pollute the environment more than other industries. You can screen those out as well. We take the approach of Switzerland. We're not here to tell you what to do, but we are here to give you the tools to help bring in your portfolio in line with your beliefs there. So that's direct indexing in a nutshell.
Yeah, Alex, that's great. Great description. Along those same lines of customization, if I'm a Eli Lilly exec and I've got a high concentration of Lilly stock, I could also direct you to not buy any more Lilly or stay a little lower on the pharma category, for instance, as well, correct?
100%. Yep. We see a lot of Eli Lilly accounts, especially in the Indianapolis area, as you might expect. So absolutely, let's underweight healthcare. Let's make sure we don't go out and buy any additional Eli Lilly shares to make sure you don't become even more concentrated that you are in that situation. Absolutely.
No, perfect. Let's go back to tax harvesting and expand on that just a little bit. Why is that important and what's that mean?
Yeah, I think the best place to start there is to talk quickly about the tax code. And I got to ask for your forgiveness for uttering that really difficult sentence, right? Don't fall asleep on me. Hopefully you haven't had lunch yet. But it's important to understand why this works. And you're going to hear all sorts of things out there on TV and in the markets on how everything's changing. One thing that doesn't change too much is taxes, right? We can count on it. So kind of tax code capital gains 101 is that if you buy stock A for, let's say, $10, and then it goes up and you sell it for $11, you made $1, right? That's a realized gain. But unfortunately, we owe a portion of that gain to the IRS in the form of capital gains taxes, right? And by the way, taxes and inflation are some of the biggest costs that investors face over their investing careers, right? So we want to try to minimize those to the extent we can. The one nice thing that the IRS gave us is that the same is true on the inverse. So say you buy stock B for $10 and you sell it for $9, you have booked a $1 short or long-term capital loss, right? And in that very simplistic example, if you have $1 gain in stock A and $1 loss in stock B, you do not owe any taxes, right? Those can offset each other. I always tell folks, please consult with your CPA and your tax professional. I am not one of those, but that's my understanding of the tax code. And so the next kind of question is, what can you do with those losses? And when we refer to tax loss harvesting, we're trying to capture as many of these B scenarios as we can while still delivering you a market-like return. And the reason we want to capture those capital losses is because, again, you can offset capital gains, which is wonderful. You can, in many cases, offset up to $3,000 of ordinary income. And very importantly, you can carry forward losses without limit and into perpetuity within the bounds of the end investor's lifespan, right, to help offset gains in future tax years. So that's tax loss harvesting. It's when a investment is down on paper and it's unrealized, going ahead and selling that security to realize that tax loss is powerful because that tax loss has benefits against other gains in the client's financial picture and situation.
No, it makes perfect sense. And as you can see, that this strategy makes great sense in a taxable account. Probably doesn't work well in an individual retirement account. We use this strategy really in taxable accounts. How many opportunities are out there for tax loss harvesting?
Yeah, that's a wonderful question. And this is one of my favorite charts. It's a little bit busy, but stick with me here, right? So here, let's look at 2023, which was a phenomenal year in the markets, right? just like 2024 was as well. We saw returns in excess of 20%. 2023, according to this chart, was up 24% in the S&P 500. Under the hood, however, this blue bar shows us that roughly 95% of stocks were down at some point in the year. In a year that was up massively, right? Wonderful returns in the market. We saw 95% of stocks that were down at some point. And further, the orange bar shows you which percentage of stocks were down 5% or more. And that's somewhere around 75%, rounding using this graph here. But the opportunities abound. And so the other example I like to give is, let's say you were an SPY or some sort of index fund investor early on in 2004. You saw 4 years of very stable returns, right? And you're stair-stepping up in your packaged vehicle, if you will. Your returns are there. That's great. But underneath the hood, you were missing out on all of these opportunities to harvest losses while still giving you that index exposure. So what does direct indexing get you? In a year like 2023, you're going to see a market return similar to that 24% figure. It does have a small tracking error component, which we'll get into in a little bit, but you're going to get that index-like return with a substantial tax asset because you're tax loss harvesting all of these opportunities underneath the hood.
So even in positive years, you might get the benefit of some volatility and book some losses along the way. Makes total sense compared to buying just the passive benchmark, in my opinion. That's why we really like this strategy.
Absolutely. Spot on, Brian.
I know in our prep call, we discussed kind of the actual investment process. Would you mind kind of just covering that a little bit, Alex? In the essence, in our essence of time, I want to keep this part shorter. Total call, my guess is a half hour for those that recently joined us.
Yeah, absolutely. And I think we'll be under that. We'll go through just the investment process really quick. So say you're interested in launching a strategy. The first thing you have to do is tell us what kind of strategy you want to track. Perhaps it's the S&P 500 and you want US exposure. Perhaps it is a global allocation or an all cap allocation. You choose, right? We want to figure out what's most appropriate for your allocation, which again, it's why it's so important to work with your financial advisor and the Cooke Group and figuring out, is this a good fit, is it not? But step one is select a benchmark. The second step would be to personalize it for the goals or values you want to express in your portfolio. Some folks take us up on that, others don't, but that's available to you. And from there, we sample and optimize the portfolio. And here's where the magic really starts in direct indexing is, let's just say in this very simple example that this is the entire market. You've got 6 companies. HCA and J&J are healthcare companies. Exxon and BP are oil and gas, and Pepsi and Coke are staples, right? Pretty well-known names. For illustrative examples, let's say that's the entire market. In order for us to deliver you a market-like return, though, we know that you don't actually need to buy every constituent of the market to get really, really close. And the reason you might bring some securities out is because you want to have a bench of stocks to bring into the portfolio and some are down. So in this simplistic example, and again, an example only, let's say we start with HCA, BP, and Pepsi. Those are the investments we make in the account, and we hold those stocks to track the index. That performance that you see in your account will track very closely to the benchmark, but you're going to have a small tracking error. That's just the difference between what your account experiences and what the benchmark actually is. And because we've taken some securities from the portfolio, that tracking error is going to be very, very minimal. If you come to us with a cash funded account, it's going to be less than 1%. And here's where the tax loss harvesting takes place. Let's say you start the portfolio and you've got some stocks are up, some stocks are down. Let's say HCA and BP are up. They're doing well. They're each up 1, but Pepsi is down for whatever reason. Don't know why. Pepsi Challenge came back and let's say the results weren't as pleasing as they thought. We say, you know what? That's all right. HCA and BP are up. Pepsi's down. Your account's up as a whole, but let's sell Pepsi. because if we sell it, remember, we've booked a tax loss, which is an asset to you. And at the same time we sell Pepsi, we're going to bring Coke into the portfolio. Your exposure is still very, very similar. And your new portfolio includes these 3 new stocks. And you continue to hold those stocks, experiencing the market-like returns. And if any of those 3 happens to be down, we'll repeat the process. So we're continuously scanning accounts to look for those loss harvesting opportunities.
Alex, how often do you repeat that process?
Yeah, the official answer is it depends. But in general, we employ a very dynamic tax loss harvesting approach. The general way we think about it is at least once a month, you should look to trade an account, right? And there's some tax reasons why you do that, something called the wash sale window. You want to be mindful of that. But then when volatility rears its ugly head in the market, we need to be dynamic enough to go in and harvest losses intra that 1 month period. So at least 12 times a year, and then more opportunistically when periods of volatility come into play where we need to trade and rebalance more often. So I would say a dozen plus times a year, 20 or more times as needed when volatility really does spike, because when volatility spikes, there's more opportunities to harvest losses, and we want to capture those for our clients.
No, I agree. And this portfolio to me is great for the business owner that might be selling a business in the future and expecting a large capital gain sometime down the road. If we could book some losses along the way, harvest those, and then offset the potential business sale gain, it makes all the sense in the world to us. So that was another point I wanted to make. And then back to tracking error, that's a tight band typically, and sometimes it works in your, works on your behalf and it's in your favor, and sometimes it's a little out of favor depending on what stock you sold and repurchased. But the tracking error tends to be pretty close to whatever benchmark we choose.
That's right. Yeah. And not to get too statistical or into the numbers, but tracking error tends to be mean reverting in nature. So if you've got a tracking error of 1%, for example, that means if the S&P is up 10, we have a reasonable expectation that your portfolio is either going to be up 11 or up 9, right? And that tends to be mean reverting over time. It can work for or against you. But in general, we want to keep that as tight as we possibly can to deliver, again, that first mandate, which is index tracking.
Last big question for me, who's this product or process really fit well with? What client should we be showing this to?
Sure. There's a lot of factors that go into that question. I'll blanket everything I'm about to say with working with the Cooke Group and your financial advisor is really important to figuring out, is this appropriate for me? I know Brian and team, I think they were 1 and 2 in the state, according to Forbes, right? They're experts at what they do. They know your personal situation. They have a better idea of your tax picture. They know how emotionally important various aspects of investing in the market are to you and your net worth and your financial plan. So please consult with them, right? That's what they are experts at, and they can help guide you through these. But that being said, a couple areas where direct indexing tends to make sense. Number one, if you're looking for beta market exposure, index-like exposure to the market, direct indexing can be a great way to get that while seeking to increase after-tax returns, banking those tax losses along the way. One of the most powerful use cases we see for direct indexing is exiting appreciated stock positions. So Brian, I'll go back to your point on concentrated Eli Lilly. Perhaps you have been an Eli Lilly employee for 10, 15 years. What a phenomenal run on the stock we've seen, right? It's been up and to the right. Great company, American darling. But we run into clients all the time who have half or maybe more on a percentage basis of their net worth in one single stock. And so what they'll do is bring Eli Lilly into a direct index SMA along with some cash or maybe a capital gains budget to kickstart the process. And we can help slowly pare down those losses captured in the direct indexing process against the gains in the Eli Lilly position. So it can be more advantageous than just an outright sale of your concentrated stock. So it's incredibly powerful there. The other scenarios, 3 and 5 here, they very much rhyme with another. And that is, direct indexing is very complementary to other active strategies. There are wonderful managed account managers out there that are active in nature. There's wonderful mutual fund and ETF managers out there where their investment process and strategy is really buttoned up and fantastic. However, sometimes those strategies can be a little tax inefficient. Not necessarily a bad thing if the investment merit is there, right, and it's accomplishing its goal. But we see a lot of folks pair a direct indexing strategy where you're capturing losses right next to those active strategies to net down the tax impact to the extent those losses are available to offset the gain. So very powerful there. Brian, you touched on this. If you are a business owner or a real estate investor, or you have some sort of large liquidation or realization event coming down the pipeline, selling a piece of property, a business, more often than not, you're going to be faced with a pretty big tax bill in those situations. So we see many investors launch a direct indexing strategy as early as they can, knowing that event's coming down the road. Because again, back to that tax slide, you can carry forward losses. And then when that big realized event comes due, you've got a warehouse full of losses to apply against that gain to help minimize the dollars you are sending to the IRS. And last but not least, I touched on this, your values-based client, somebody who wants to express their views from the values standpoint, again, religious, ESG, social, or otherwise. It's a great tool to apply in those situations.
I agree with all that. And I've watched you build portfolios for some of our clients, some with some large concentrated positions too. And watching you pair that over the years has been efficient. The clients very much appreciated it. And it's also a good discipline process for those that are so heavy in one position. So I love the product for that. I have looks like we got a couple clients that have asked questions in the chat room, and sure. I see one here. It looks like it's, does lost harvesting adversely impact your returns? Great question.
Yeah, this is a great question. And I think mentally what is most important to grasp with direct indexing, more often than not, or on average, the answer is no. So I like to compare it to a mutual fund or an ETF that tracks, let's just say, the S&P 500. If you own those vehicles, again, fantastic ways to hedge inflation and grow your wealth over time, at least historically. More often than not, stocks have gone up and to the right over time. However, underneath the hood, there's some stinkers in there, right? There's stocks that fall out of bed, management changes happen that the market doesn't agree with, profits fall. You just don't necessarily see that because you only see the average return baked into the NAV or the market price of that vehicle, right? But in direct indexing, you own the individual name in the account. And so we're saying, hey, even though stocks go up over time, at least historically, let's just take advantages of the ones that fall. And by owning the individual names in the SMA, you're able to capture that loss. So you're probably experiencing those losers of stocks in your packaged vehicles. You just don't see them. So the returns tend to be very similar over time.
Great. I got one more question I see in the chat room too. What kind of loss capture can an investor expect? Maybe even in a low volatility year or a volatile year? Give me some scenarios there.
Sure. The official answer is that it totally depends, and not one year ever looks alike. However, there is a pattern, and as you might expect, in periods of volatility or years that are down in the market, your loss capture is substantially higher than when the market is up. And that makes intuitive sense, right? If more stocks are down, there's more opportunities to sell stocks while they're down. So in a year like 2022, pretty ugly year in the market, right? We don't ever wish that again, and we hope that doesn't happen again. We're investing to make money. But in a year like 2022, we saw loss capture in the high 20 to very low 30% range of the account's value. That's assuming that the account was launched in cash at the beginning of the year. There's a lot of variables, right? When did you launch your account? Was it funded in kind or was it funded with cash? At what point in the year did you fund it? All of that matters in a major way when it comes to loss capture. And if you look at a year like last year, we just closed the books on 2024. Phenomenal year in the market. A lot of folks did really, really well. I think low single digits on a percentage basis of an account's value captured in losses. So it totally depends. It depends on the breadth of the market. It depends on volatility. No account looks similar. But in general, if you can picture just kind of a line, the higher returns in the market, the lower your loss capture and vice versa on the other side.
Yeah, perfect. No, Alex, it's been excellent, very educational and super insightful. I'm glad we got to introduce this topic to some of our clients and friends today. I like the product for all the reasons you described. It's something that I personally use as well, and I build active managers around this kind of a core strategy. And I don't mind. No one likes losses, but if I can use those efficiently to offset some future gains, why not? So I really appreciate the partnership with First Trust. You guys do an excellent job for us with education materials, value adds, and supporting the Cooke Financial Group. For those on the call today, really appreciate your time. As I said, I thought we could hold this to a half hour. It's about right on time. So thank you very much for joining us. If you have more questions about direct indexing or any products, obviously call the Cooke Financial Group. Happy to pull Alex in on a future call if you want to have more specifics. I did see someone raise a hand to ask a question. If you could type it in the chat room, then we might be able to answer that just before we go. Let's see. The question says, what is the average percent of return increase? And so it's a little vague, but Alex, I'll let you try that one.
Yeah. Again, please consult with your CPA and your financial professional team. Over time, we see about 2.5% I'll call it outperformance through just the tax loss harvesting piece. And again, that can go up or down in a major way depending on your financial situation. I'll tell you, it is most appropriate for those who have gains to offset. If you are pairing a loss with a gain you have, that's a great economic benefit. Those are dollars that get to stay in your account invested over time, right? So you're going to see a bigger impact there, but all else being equal, call it 2.5% on average. And by the way, that comes very quickly in the early life of an account, because if you have fresh cost basis, you're able to harvest more losses out of the gate. And because stocks go up over time historically, you tend to see that loss capture drift off in later years. So more upfront, less later, all else being equal.
I totally agree with all that. For those of you out there that want to own an index, whether it's the S&P 500 and you just want to buy one symbol and it's an ETF SPY, to me, this is a much more efficient way to do that. There are minimums, there are higher fees than just a straight passive ETF. But if I can get 2.5% or 3% tax alpha over and above a benchmark, more than pays the fee, and I'm a much happier investor. So that's my plug for direct indexing. I think it has a neat fit for an awful lot of clients with taxable assets. So I'm going to leave it there, Alex. Thank you so much for your time. Thank you, clients and friends of the Cooke Financial Group, for joining us for our In the Bullpen webinar. If you have questions, give us a call. We look forward to the next time we get together. Have a great day. Thank you so much.